Okay, let's dive in. Thinking about money. It's not just crunching numbers, is it? It feels much deeper, more about, psychology, our own history.
Exactly. It's tied so deeply into how we feel, what we believe from our past experiences. It's personal.
And that's what we're exploring today, actually, based on a request from one of you listening, The Learner. We're looking at Morgan Housel's book, The Psychology of Money.
Right, and it's great because it uses stories, not just dry facts, to show how our own behavior really drives our financial results.
Yeah, it argues pretty strongly that managing your emotions and knowing your own mindset, that's maybe more important than being a math whiz.
It really is. It's about
Oh.
the soft skills of money.
So our mission really is to pull out those key ideas from the book, the things that can genuinely help you make, well, better financial decisions by understanding these sort of hidden psychological forces.
We want to give you a shortcut, basically, to understanding why we all do the things we do with money without getting bogged down.
Okay, so first big idea. What does financial success really look like? It's maybe not what you'd immediately think.
Yeah, this genius versus success thing. We assume smart people are automatically good with money, but maybe not.
Housel tells this story, right? About a tech exec, brilliant guy, helped design Wi-Fi, sold companies young, super intelligent.
No question about the IQ points there.
But House's point is, even someone that smart, if they lose control of their emotions, maybe panic or get greedy, they could still be a financial disaster.
It shows that just being clever isn't enough when you're dealing with the ups and downs of markets and, your own feelings about money.
And then he contrasts that with Ronald Reed. Remember him?
Oh yeah, the janitor and gas station attendant from Vermont.
Exactly. Not a fancy background. First in his family to finish high school, I think. Hitchhiked to get there.
But the amazing thing is he built up a really significant fortune, quietly, over decades.
Just by patiently investing. Simple blue chip stocks letting dividends reinvest. For years and years.
And then compare that to Richard Fuscone. This guy had everything on paper. Ivy League education, top job at a big finance firm, huge houses.
Yeah, one house had like a see-through floor over an indoor pool. Wild stuff.
But his story ends differently. He got caught up in debt, trying to maintain this lavish lifestyle fueled by, well, greed, basically. Ended up in foreclosure.
So you have the janitor who dies wealthy, leaving millions to charity, and the Harvard-educated finance exec who goes broke.
It's a stark contrast. And it leads right to Housel's main point. Financial success is often less about what you know and much more about how you behave.
It's a soft skill. Consistency, patience, controlling your emotions. That beats raw intelligence sometimes.
Which leads perfectly into the next idea.
Uh,
How our own personal history totally shapes our view of money.
oh, this is huge. Everyone has a unique money story, right? And that story forms the lens through which you see everything financially.
Absolutely. What seems completely crazy to one person might make perfect sense to another, just based on what they've lived through.
Like growing up poor versus growing up wealthy, your attitude towards risk, saving, spending, it's going to be fundamentally different. It's wired in.
Or think about inflation. If you lived through the 70s watching prices shoot up, you're probably always going to worry about your money losing value in a way someone born in the 90s might not.
Right, because they've mostly seen stable prices. It's not the same boogeyman.
Same with experiencing a major recession like the Great Depression versus maybe just seeing the late 90s tech boom. Your baseline understanding of economic stability or fragility is just different.
It even varies by country, doesn't it? Like Australia not having a recession for ages versus the US experience, those national backdrops matter.
And these personal or local experiences, even if they seem small on a global scale, they heavily influence how you think about risk, reward, what investments feel safe or dangerous.
Howsam mentions research confirming this, doesn't he? Malmendier and Nagel.
Yeah, they found a clear link between the economic conditions people experienced, especially in their younger years, and how much financial risk they're willing to take later on.
So it's not just cool logic, it's our lived experience shaping our choices.
Definitely.
Mm-hmm.
Bill Gross, the bond king, even said his view of bonds was shaped by being born when interest rates were starting their long decline. His dad's generation saw them differently.
It makes sense. Your formative years set your mental model.
And it's not just big events. Think about unemployment. The national average might be one thing, but your personal experience or that of people, like you say, based on education or demographics, that's what shapes your view of job security.
Totally. If your community struggles with unemployment, that national average doesn't mean much to your sense of financial safety.
which explains why people can look at the exact same financial data or advice and come to completely opposite conclusions. Their personal history filters it differently.
Which leads us to think about how financial decisions become part of our personal story.
Right, this idea that every financial decision, however odd it might look from the outside, actually makes sense to the person making it at that moment.
It fits their mental model, their narrative of how the world works, which is built from all those experiences we just talked about.
Even if someone's acting on bad information, or maybe making what we'd see as a mistake, there's usually an internal logic driving it, their own story.
Housel uses the example of people buying lottery tickets, particularly lower income folks. Rationally, the odds are terrible, right?
Yeah, seems illogical to spend scarce money on such a
But,
long shot.
but if you dig deeper, maybe for that person, it represents the only glimmer of hope they see for drastically changing their circumstances. It's not about the math, it's about buying a dream, however unlikely.
You don't have to agree with it, but you can start to see the reasoning behind it within their specific context.
And that's the key. Financial decisions aren't made in a vacuum with just a spreadsheet. They happen in real life, influenced by ego, marketing, social pressure, our past, all that messy human stuff.
It really brings home that finance is deeply human, not just numbers.
And speaking of context, it's kind of wild how new a lot of our modern financial world actually is.
That's such a crucial point. We take things like retirement planning or 401ks for granted, but they haven't been around that long at all.
Think about retirement itself. The idea that most people would stop working and live comfortably for years, that's largely a post-World War II concept. Before that, you mostly worked until you couldn't.
Yeah, and even with Social Security starting, it took a long time for widespread, comfortable retirement to become an expectation.
And that old idea that everyone used to have a solid company pension, Housel points out that's mostly a myth. Even in the 70s, it wasn't nearly as common as we think.
It was really the 80s when the shift happened, the idea that you are primarily responsible for saving for your own retirement.
And the main tools for that, the 401k that only showed up in 1978, the Roth IRA, 1998, these are practically teenagers in financial history terms.
Exactly. So no wonder so many people struggle with saving for retirement. We're all kind of the first generation, or maybe the second, really expected to figure this out on our own. We're newbies.
It's like we're all learning on the job. Same goes for college, right? The massive rise in attendance and costs is also pretty recent.
Which helps explain the student loan crisis. There wasn't a long history or generations of experience to guide people making those borrowing decisions in the last couple of decades.
We're figuring it out as we go. And you can add index funds to that list, less than 50 years old. Widespread consumer credit mortgages, car loans, credit cards that really exploded after WWII too.
So when we struggle with these things, it's maybe not just personal failure. We're navigating a system that's still relatively young and constantly changing.
Which brings up another factor we often overlook: luck and risk.
Ah, yes, the uncomfortable truth. Success isn't always just skill, and failure isn't always just mistakes. Luck plays a huge part.
Housel uses Bill Gates as an example. Getting access to that computer at Lakeside School so early. That was a lucky break, a huge one.
Absolutely. Right place, right time, combined with his talent and drive, of course.
And meeting Paul Allen, another key connection. But then there's the story of Kent Evans.
Right, the third friend.
Yeah.
Equally talented, equally ambitious, could easily have been a co-founder of Microsoft.
But he died tragically in a hiking accident before they started the company. A completely random, unforeseen event that changed everything. It just highlights the fragility of it all.
It really does. And Housel knows how hard it is to talk about luck. Pointing it out in others sounds like jealousy. Acknowledging it in ourselves feels like undermining our own effort.
Yeah, it's tricky. There's that research, too, about how brothers' incomes are often more similar than even their height, suggesting that shared background luck essentially plays a big role. But we tend to focus on the individual effort.
It's easy to fall into the trap of thinking success is all skill. Like Cornelius Vanderbilt saying, "Ain't I got the power? Works until it doesn't," you know?
Exactly. Even the investing legends aren't immune. Benjamin Graham, the father of value investing, Housel points out that a huge chunk of his fund's success came from one massive concentrated bet on JCO.
Which actually kind of broke his own rules about diversification. Was it genius or luck? Graham himself admitted it was hard to tell sometimes.
It just shows how tangled up skill and chance really are in finance.
Which leads to a really fundamental question. How much is actually enough.
Oh, I love this part. That anecdote about Kurt Vonnegut and Joseph Heller at the billionaire's party.
It's brilliant. Vonnegut says something like, that guy made more money yesterday than your novel Catch-22 made in its entire history.
And Heller just replies, yes, but I have something he will never have.
Enough.
Boom. Just perfect. It nails the idea that chasing more and more doesn't necessarily bring more happiness or satisfaction.
And then you contrast that with the story of Rajat Gupta. Incredible story rags to riches, CEO of McKinsey, worth maybe $100 million.
Seems like more than enough, right?
You'd think. But he wanted more. Enough wasn't enough. He got involved in insider trading, chasing even greater wealth, and ended up in prison.
It's a cautionary tale about how that hunger for more, that inability to define enough, can lead to ruin even when you're already incredibly successful.
Housel talks about the hamster wheel of social comparison. No matter how much you have, there's always someone with more. The goalposts keep moving.
It's a game you can't win, so recognizing enough is about stepping off that wheel. It's realizing that the pursuit of more can actually cost you things that matter far more: your reputation, your freedom, your peace of mind.
Like with Gupta or Bernie Madoff. Pushing too hard for more led them to disaster. Defining enough is crucial for long-term well-being.
And thinking long-term brings us to the next point: the incredible power of compounding and patience.
Yeah, this is where the real magic happens, but it's slow magic. It's not dramatic day to day.
Housel uses that amazing analogy of ice ages, these massive planetary shifts caused by tiny, tiny changes in Earth's orbit over thousands of years.
Right, subtle variations in sunlight hitting different parts of the Earth. Barely noticeable year to year.
But add up those tiny changes over millennia, and you get these colossal ice sheets. The key, as that glaciologist said, isn't necessarily how much snow falls, but that the snow lasts. It accumulates.
And that's compounding in finance, isn't it? It's not always about huge yearly gains. It's about consistent, steady growth building on itself year after year, decade after decade.
He does that thought experiment with Warren Buffett. Imagine Buffett got the same amazing returns, but only started investing at 30 and stopped at 60.
The difference is mind-blowing. His net worth would be like 99.9% less than it is today.
So almost all his wealth isn't just from being a genius investor. It's from starting young and staying invested for an incredibly long time. Time is his secret weapon.
Yeah, compare him to Jim Simons at Renaissance Technologies. Simons actually has higher average annual returns, much higher.
But he started later, so Buffett, with lower average returns but decades more time, ended up far wealthier.
It's so counterintuitive. Shows how easily we underestimate the power of time and consistency. Like the explosion in data storage capacity, it grew exponentially in ways few predicted.
So the takeaway is patience. Let the compounding work. Don't interrupt it.
But to let compounding work, you need to stick around. Which brings us to the importance of survival.
Right. Getting rich is one thing. Staying rich is another skill entirely.
Howell tells the story of Jesse Livermore and Abraham Termansky in the 1929 crash. Livermore actually made a fortune shorting the market. Termansky, a developer, was wiped out.
The story continues. Livermore got overconfident, made huge risky bets later, lost it all, and ended tragically.
It shows that getting wealthy doesn't guarantee you'll stay wealthy. You have to manage risk and prioritize survival.
And this isn't just for famous traders. Look at the Forbes 400 list, lots of turnover decade to decade. Or how many public companies eventually lose most of their value. Staying power is rare.
Compounding needs years, like growing that oak tree. You have to survive the storms, the droughts, the market crashes along the way.
Housel lists what Buffett didn't do as key to his success. Avoiding huge debt, not panic selling, protecting his reputation, staying flexible, not being forced to sell at bad times because of leverage, avoiding burnout.
His survival, his longevity, is maybe the most impressive part of his record.
So it's not just about chasing the highest returns, it's about building resilience so you can stay in the game long enough for compounding to do its thing.
Which leads directly to the idea of margin of safety or room for error.
Yes. This is so important. Housel says failures often happen not because you were totally wrong, but because you were mostly right, but needed everything to go perfectly. No buffer.
Margin of safety is that buffer.
Yeah.
It's increasing your odds by being able to withstand things not going exactly as planned. A flexible budget, adaptable thinking, loose timelines.
It's not just being conservative and avoiding all risk. It's about taking calculated risks, but ensuring you can survive if things go sideways, building in resilience.
He uses that analogy of brain development. We prune away connections to become more efficient. Similarly, economies and markets need to weather volatility and setbacks to achieve long-term growth.
Look at the U.S. economy. Huge long-term growth, but punctuated by numerous recessions, wars, crises. It survived because there was enough underlying strength, enough room for error.
That resilience is key. And speaking of ups and downs, let's talk about tail events.
Right, those extreme outcomes. Housel starts with that Brad Pitt quote, "Some work and some don't." Simple but profound for investing.
And the story of Heinz Berggruen, the art dealer who had an unremarkable early life but became hugely successful later. Success can come from unexpected places.
The core idea is that a huge portion of results, good or bad, often comes from a tiny number of extreme events, the tails of the distribution curve.
Think of Walt Disney. Lots of early cartoons lost money. It was the few massive hits, the tail events like Snow White, that drove the company's success.
Or venture capital. Most investments fail or do okay. It's the one or two Googles or Facebooks in a portfolio that make all the difference. The outliers.
And it works on the downside, too. Carrasco Pictures' huge movie studio, massive hits, then suddenly bankrupt. A negative tail event.
The stock market itself is like this. A small number of companies drive most of the overall gains over long periods.
So for you as an investor, Housel argues, much of your lifetime success will probably hinge on how you behave during a few critical moments of market stress or euphoria.
Like that pilot analogy. Hours of boredom punctuated by moments of sheer terror. It's how you handle the terror that counts most.
Jeff Bezos gets this. He's okay with big failures like the Fire Phone, because the potential upside from a tail success like AWS is so enormous it dwarfs the losses.
And we usually only see the final success, right? Not the mountain of failures that came before, like Chris Rock testing hundreds of jokes to get that polish hour special.
Even Buffett admits most of Berkshire Hathaway's value comes from a handful of investments. Munger says without their top few picks, their record would be pretty average.
So failure is normal. Lots of small losses or mediocre results are part of the process. What matters, as George Soros said, is how much you make when you're right versus how much you lose when you're wrong. You need those big wins to outweigh the inevitable misses.
Which brings us back to a fundamental question. What are we actually aiming for with all this? What's the true meaning of wealth?
Housel's answer is powerful. The highest form of wealth is the ability to control your own time.
That's it, isn't it? People chase money because they think it buys happiness. And a huge part of happiness is feeling in control of your life.
Freedom, doing what you want, when you want, with who you want, for as long as you want. That's the ultimate prize money can buy.
Derek Sivers' story illustrates this perfectly. He figured out he only needed a modest amount saved to quit his job and be a full-time musician. That was his point of enough when he bought back his time.
It shows wealth isn't just a number, it's options, it's autonomy.
And it's why, paradoxically, the U.S. is the richest country ever. But happiness levels haven't really tracked that wealth increase since, say, the 1950s.
More stuff doesn't automatically equal more happiness. Maybe losing control over our time with modern work demands cancels out some of the benefits of wealth.
There is also the paradox of the car. We buy fancy things hoping for admiration, but people often just admire the thing, not the person, and use it as a benchmark for their own desires.
Right. And Housel stresses that true wealth is often invisible. It's the money you didn't spend, the assets you've accumulated quietly.
That's the difference between being rich, high income, visible spending, and wealthy, having assets that provide freedom and security, often unseen.
Which makes wealthy people harder to emulate. You see the fancy car, rich, but you don't see the years of disciplined saving, wealthy, like Ronald Read, whose wealth only became visible after he died.
And that invisible wealth is often built on a simple, powerful foundation: saving.
It sounds almost too simple, but Housel makes a strong case that your savings rate is more important than your income or investment returns for building wealth.
He uses the 1970s oil crisis analogy. We didn't just find more oil, we got way more efficient with the oil we had. Better cars, better insulation.
And in personal finance, saving is like efficiency. It's the part you have the most control over. You can't control market returns and maybe not even your income entirely, but you can control how much you spend versus save.
Focusing on boosting your savings rate puts you in the driver's seat, much more than hoping for lottery-like investment gains.
A high savings rate just gives you that gap between income and spending. It creates wealth regardless of returns initially. It buys you options, security, that control over time we talked about.
Especially now with global competition, having that financial cushion, that control, is arguably more valuable than ever. Saving provides that.
Okay, moving towards wrapping up, there's a subtle but important point about being reasonable rather than purely irrational.
Yeah, this is about acknowledging we're human, not robots. Aiming for mathematically perfect, rational decisions might not work if you can't stick with them emotionally. Reasonable is often more sustainable.
He uses that wild historical example, giving syphilis patients malaria to induce a fever, which actually sometimes helped fight the syphilis. Totally irrational on the surface, but there was an underlying unexpected mechanism at play.
It shows our intuition or feelings aren't always wrong, even if they defy simple logic. Like how we instinctively dislike fevers, even though they help fight infection.
In finance, Harry Markowitz, Nobel laureate, admitted putting bonds in his own portfolio not just for optimal returns, but because it helped him sleep at night, helped him stick with the plan. That's reasonable, even if not perfectly rational.
Trying to be purely rational might lead you to take risks you can't emotionally handle, causing you to bail at the worst time. A reasonable approach considers your own psychology.
Housel even suggests loving your investments might be reasonable if it helps you hold on through thick and thin, even if it sounds purely emotional.
Because sticking with a decent plan long term is usually better than jumping in and out of a theoretically perfect one. Reasonableness supports longevity.
And thinking about the long term also means acknowledging the limits of history.
Right. Scott Sagan's quote. Things that have never happened before happen all the time. History's a guide, not a perfect map of the future.
Relying too much on past experience can be dangerous. As Heisel notes, people who live through one specific event might be overly confident or biased when facing the future.
Like Michael Batnick's point. Just because today's investors haven't seen decades of rising interest rates doesn't mean the playbook from the 70s applies directly now. The context is different. Big shifts often come from things nobody saw coming. Surprises are the only certainty, really.
And the financial world itself changes. 401k, Roth IRAs, these didn't exist decades ago. Recessions might happen differently now. Even advice from legends like Ben Graham needs context. His formulas might not work the same way today.
So, learn from history, yes, but don't expect the future to be a simple repeat. Be prepared for novelty.
Which means you absolutely must accept that you can be wrong.
Humility is key. Knowing what you don't know, like the blackjack card counter needing a big bankroll to survive bad luck streaks, even with an edge.
You need that room for error, that margin of safety, because things will go wrong sometimes. Your assumptions will be off. Markets will do crazy things.
Leverage is especially dangerous here. It turns small errors into potential catastrophes.
The barbell strategy makes sense in this light. Be super safe with most assets, allowing you to take some calculated risks elsewhere, knowing your survival is protected.
Room for error protects you not just from known risks, but from the truly unimaginable stuff. The black swans, the mice defeating tanks, as Housel puts it.
Your plan needs to account for the possibility of things going completely off the rails.
And finally, let's touch on the seduction of pessimism.
It's funny how pessimism often sounds smarter, doesn't it? More sophisticated than optimism.
Housel explains why. Pessimism acknowledges risk, which feels prudent. Optimism can sometimes sound naive. But real optimism isn't expecting rainbows every day. It's believing things will generally trend upwards over time, despite setbacks.
Pessimism grabs attention. Bad news travels fast. Think about 2008. The dire predictions got way more airtime than optimistic ones.
Or predicting Japan's post-WWII boom would have sounded crazy then. Gloomy forecasts often seem more plausible than wildly positive ones.
The financial news cycle often feeds on fear, even when long-term trends are positive.
It taps into that human bias Ridley and Rosling talk about. We tend to think things are worse than they are. And because money affects everyone, financial pessimism feels immediate and personal.
Progress is often slow, invisible day to day, while setbacks are sudden and dramatic. Plane crashes get headlines. Decades of improving aviation safety doesn't.
Housel's alien analogy is great. The U.S. economy's potential didn't vanish in 2008, but the story changed. The pessimism took hold, and that had real consequences.
When stakes are high and control feels low, we crave stories, explanations. Sometimes we'll believe almost anything, like bizarre plague cures back in the day.
Which is why people fall for financial gurus or schemes like Madoff's. The stakes are so high, the desire for a winning story is incredibly strong.
We're all just trying to make sense of a complex world with limited information, creating our own narratives.
Okay, so pulling it all together, what have we learned? Understanding the psychology, your history, luck, the need for patience and room for error, the lure of pessimism, it's all crucial.
It's about making decisions that fit you, your life, your temperament, not just following some generic formula.
Definitely. And like that story about Clarence Hughes getting unwanted dental work, specific financial advice is tricky. It has to be personal.
But maybe some key things to reflect on from Housel. Be aware of your own biases from your past. Focus on that savings rate. It's hugely powerful.
Aim for being reasonable with your finances, something you can stick with, not just rational on paper. And accept that volatility is normal, the price of admission for potential long-term gains.
Build in that margin of safety. Be skeptical of extreme predictions, good or bad. Define what enough truly means for you. You don't get caught in endless comparison.
And remember that ultimate goal, using wealth to gain control over your time. That's real freedom.
So maybe the final thought for you listening is this. How have your specific life experiences shaped how you think and feel about money right now?
And based on everything we've talked about today, is there maybe one small, reasonable adjustment you could consider making looking ahead for a financial future that feels more secure and maybe even more fulfilling?